This video will help you understand how to treat an inherited Roth IRA. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. While inheriting a retirement account is all too common nowadays, the majority of retirement account inheritances come through as pre-tax inherited IRAs. However, with recent legislation changes and people forecasting higher income tax brackets in the future, a lot of the inherited retirement accounts you're going to start seeing are going to be Roth IRA or Roth inherited accounts. So in this video, we'll break down the differences that come with inheriting a Roth IRA. So let's jump in. So to quickly just establish a baseline, generally, when money is withdrawn from a traditional or pre-tax IRA, generally that entire distribution is going to be considered taxable income to the income recipient. On the contrary, a Roth IRA in general would distribute assets tax-free to the income recipient. Now, there are some circumstances where a traditional IRA can kick out tax-free income, and when a Roth IRA can kick out income taxable income, but we'll save those nuances for maybe another video. But generally, a pre-tax IRA is taxable and a Roth IRA is tax-free. These same tax ramifications carry over from the original owner of the account to the beneficiary who inherits the account. It's the same tax consequences. However, to figure out how to treat your inherited Roth IRA, the first step is going to be to figure out what type of beneficiary the IRS classifies you as. As of recent legislation, the IRS breaks down beneficiaries into three main categories: eligible designated beneficiaries, non-eligible designated beneficiaries, and then not designated beneficiaries. Eligible designated beneficiaries are going to be the surviving spouse, and then a few other nuanced definitions such as the minor child of the decedent if they're less than 18 years old, an individual who's disabled, an individual who's chronically ill, and then any other individual as long as that person isn't more than 10 years younger than the decedent. Non-eligible designated beneficiaries, which is everybody else, those folks are going to have different requirements to treat their inherited Roth IRAs. And then non-designated beneficiaries, those are basically institutions, trusts, charities, not people, and they're going to have their own rules for how to treat an inherited Roth IRA. I'll link below to the videos that I've put out in the past breaking down these definitions a little bit more in detail, and that'll help you identify which beneficiary type the IRS would consider you. Now, if you inherited a traditional IRA, you'd have one more calculation to figure out, which is whether or not the decedent, the person who passed away, met or did not meet their required beginning date, which is the date in which they're supposed to start taking out required minimum distributions. With a Roth IRA, however, you can hit the easy button because the IRS simply says, well, since there are no required minimum distributions that one needs to take out of their Roth accounts nowadays, when the person passes away, you get to consider them as having never met their required beginning date. And that's because there is no required beginning date on Roth accounts. There is never a time where you must take out mandatory required minimum distributions. Not only is this nice because it's less work for you to figure out, how to treat these accounts, but it's also nicer because generally inheriting money before the decedent met their required beginning date gives you, the beneficiary, a little bit more optionality. So first up, if you do some research and find out you're an eligible designated beneficiary, let's break down what options you have. Now, if you're an eligible designated beneficiary, specifically if you're the surviving spouse of the decedent, which I'd hope you know before inheriting this account, but let's just say you do some research and you find out you're the surviving spouse, you'll have a few options for how to treat this inherited account. Number one, you can simply classify this Roth IRA as your own Roth IRA. You could combine it with your other Roth IRAs, treat it as a standalone account, but all the rules and regulations that the IRS imposes go along with this being your own Roth IRA. Meaning, if you're under the age of 60, or 59 and a half, if you take money out of this account, you'll pay an early withdrawal penalty, generally. So, unless you are over the age of 59 and a half, you might want to look into some other options, especially if there's a liquidity need, aka you need to pay bills and you need this inherited retirement account to do that. Your other options would include creating a stretch Roth IRA, and that's where the account is labeled an inherited Roth IRA, but you have to take out required minimum distributions, which is a little bit of money, every year based on your life expectancy. And again, this could make a lot of sense if you're well under the age of 60 and you have liquidity needs and you need cash flow. Maybe the inherited Roth IRA is a great place to pull the funds from. All that income is going to be considered tax-free, minus a couple of exceptions, and so that might be a good option. Your third option is to classify yourself as an eligible designated beneficiary, mark this account as an inherited Roth IRA, and then follow the 10-year rule in years 1 through 9 following the year of death. You will not have a required minimum distribution from this account. The account can continue to compound and grow with the markets. However, by the end of the 10th year of owning this account, the entire account must be liquidated. Now, of course, you could accelerate distributions if you wanted to and take money out faster. You could take all the money out the day you get it, and that would not be income taxable. It'd all be tax-free. But let's say for some reason you want to not take out any money for the next 9 years, and then in year 10 fully liquidate the account. The 10-year rule would let you do that. Quite frankly, I really don't see what the value in doing that is. I think for most situations, the stretch IRA or simply taking the Roth IRA as your own Roth IRA would make the most sense. So if you inherit these funds and you're an eligible designated beneficiary, but you're not the spouse, unfortunately, you only have one option, and that is to choose the stretch Roth IRA. And that's where you have to take out a mandatory required minimum distribution every year from this Roth IRA until the day you pass away or until the account's fully liquidated. And the schedule for how quickly to take out funds will be dictated based on the life expectancy of whoever was younger, either the decedent or the beneficiary. Generally, the beneficiary is going to be the younger of the two, but there's cases where the inheritor of this account, the beneficiary, was older than the decedent. And in those cases, they would follow the ghost life expectancy of the decedent. Now, there's extra rules for minors who inherit a Roth IRA. We're not going to get into the nuances there, but just know if this is your situation, it might make sense to hire a tax professional and get some advice there. Moving on to non-eligible designated beneficiaries. If you inherit a Roth IRA, you'll need to follow the 10-year rule. And we touched on this earlier with spouses, and it's the exact same thing. In years 1 through 9, following the date of death, you will not have to take out a required minimum distribution. You could if you wanted to, but you don't have to. However, in the 10th year, the account must be fully liquidated. This is different than, say, back in 2012 or 2010 if someone were to pass away. Whereas non-eligible designated beneficiaries, as we call them today, which was pretty much everybody other than the spouse back in the day, they could do a Roth stretch IRA. However, given recent legislation changes, that's no longer permitted. So if you're not the surviving spouse or one of the 5 aforementioned demographics, you'll be a non-eligible designated beneficiary and you'll have to fall in line with the 10-year rule. Now, lastly, and you'll know if this is you, if you're a non-designated beneficiary, aka you're the person in charge of either the trust, the charity, the business, whatever, you will have to follow the 5-year rule. Similar to the 10-year rule, the 5-year rule basically says that there are no required minimum distributions in years 1 through 4 following the date of death. However, in the 5th year, the entire account must be liquidated. Again, you can accelerate distributions if you want to, but generally I'm not really seeing a good argument for doing that unless you have, massive liquidity needs, because letting this money compound tax-free for at least 5 years is a great way to save on taxes. And remember, when this Roth IRA comes out as income, for the most part, you should plan on it being entirely tax-free. I'll link above here to another video I just pushed out on some common do's and don'ts relative to some regulations with inherited retirement accounts. Basically, can you contribute to them? Can you do Roth conversions, etc.? It might be good information to check out because it does apply to inherited Roth IRAs as well. Hopefully that was helpful in breaking down if you are the beneficiary of a Roth IRA and you want to know what your requirements are to not land in the IRS's bad graces. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Hope you have an awesome rest of your week. We'll talk to you later. Bye.